Before we begin today's analysis, I want to extend an invitation. If you value measured, rational financial insights that prioritize discipline over emotion, consider subscribing to this channel. We focus on clarity, historical context, and strategic thinking in an industry often dominated by noise. No hype, no guarantees, just thoughtful guidance for serious investors. Now, let's address what may be one of the most significant developments in the precious metals market this year. A precious metals dealer recently made a statement that sent ripples through the investment community. "This could destroy us," he said, his voice strained with genuine concern. He wasn't talking about price volatility. He wasn't discussing market manipulation by central banks or futures traders. He was speaking about something far more insidious: the alleged infiltration of counterfeit silver into the global supply chain. Reports suggest that as much as 60 tons of fake silver bars, sophisticated forgeries bearing legitimate hallmarks, may have entered circulation, with evidence pointing toward Chinese manufacturing operations as a potential source. Is this claim verified? What does it mean for the integrity of the physical silver market? And most importantly, how should rational investors respond? Today, we're going to examine the situation with the seriousness it deserves. We'll cut through the panic, analyze the evidence, understand the historical precedent, and develop a strategic framework for navigating this uncertainty. Because in moments like these, discipline separates wealth preservation from wealth destruction. Let's begin with what we actually know. Over recent months, reports have emerged from dealers, refiners, and private assayers describing unusually sophisticated counterfeit silver products entering Western markets. These aren't crude imitations. We're talking about bars with correct weight, proper dimensions, and professional-grade hallmarks that match legitimate refiners. Some even pass preliminary visual inspection. The deception is revealed only through more advanced testing methods: X-ray fluorescence, ultrasonic analysis, or destructive assay. What makes these counterfeits particularly dangerous is their construction. Many use a silver-plated tungsten core. Tungsten has nearly identical density to silver, making weight-based detection extremely difficult. The alleged volume, 60 tons, represents a meaningful but not catastrophic percentage of annual silver investment demand, which runs approximately 200 million ounces, or roughly 6,200 tons per year. But the number itself isn't what matters most. What matters is the erosion of confidence in physical verification systems that the entire precious metals ecosystem depends upon. The precious metals market operates on trust. Unlike stocks or bonds, which are electronic entries in brokerage accounts, physical precious metals are tangible assets. Their value proposition rests on the certainty that what you hold is genuine. When that certainty is compromised, the implications cascade through the entire market structure. Dealers must now invest in more sophisticated testing equipment. Insurance costs rise. Transaction times lengthen as additional verification steps become necessary. Premium spreads widen to account for increased risk. For investors, the psychological impact can be even more significant. Many people hold physical silver precisely because they distrust paper assets and electronic systems. They want something real, something they can touch, something beyond the reach of banks or governments. If the physical asset itself becomes questionable, that fundamental value proposition weakens. This is why a dealer might genuinely say, "This could destroy us." Not because 60 tons will collapse the market, but because widespread doubt could fundamentally alter how physical precious metals trade. Trust, once broken, requires years to rebuild. Now, let's be clear about what remains unverified. The specific claim of 60 tons from China has not been independently confirmed by major regulatory bodies or international organizations. Much of the reporting comes from industry insiders, dealer networks, and online communities. This doesn't mean the claims are false. It means we must approach them with appropriate skepticism while taking reasonable precautions. What we do know with certainty is that counterfeit precious metals are not new. Gold-plated tungsten bars have been documented for over a decade. The U.S. Mint has prosecuted numerous counterfeit coin operations. European refiners regularly detect fake products attempting to enter their supply chains. The question isn't whether counterfeiting exists. It clearly does. The question is whether we're seeing a significant escalation in volume and sophistication. Several factors suggest the current situation may represent a meaningful shift. First, the reported geographic concentration. Multiple dealers have noted that problematic bars often trace back through similar distribution channels with Chinese origins. Second, the technical sophistication. These aren't backroom operations producing obvious fakes. The manufacturing quality suggests organized production with access to professional equipment. Third, the breadth of reports. This isn't one dealer or one region. Concerns are emerging from the United States, Europe, and Australia simultaneously. Does this constitute proof? No, but it warrants serious attention from anyone holding or considering physical silver. Understanding history provides perspective that prevents overreaction. Counterfeiting precious metals is as old as precious metals themselves. In ancient Rome, silver denarii were frequently debased with copper. Medieval European mints clipped coins and restruck them with lower precious metal content. The Spanish Empire struggled with fake pieces of 8 throughout the colonial period. In modern times, the problem has evolved with technology. The first major wave of sophisticated counterfeits emerged in the 1980s, when tungsten-cored gold bars were discovered in Hong Kong. The incident shook the market, but didn't destroy it. New verification protocols were established, and the industry adapted. In 2012, a significant operation in China was uncovered producing fake gold bars with tungsten cores. Some estimates suggested tens of thousands of these bars entered circulation before detection. Again, the market absorbed the shock. Dealers upgraded their testing procedures, premiums adjusted temporarily. The ecosystem evolved. More recently, the proliferation of fake American silver eagles and other bullion coins has become a persistent challenge. The U.S. Mint continuously updates security features, and dealers have developed sophisticated detection methods. What does history teach us? Counterfeiting creates disruption, not destruction. Markets adapt. New verification standards emerge. The fundamental demand for precious metals persists because the underlying reasons people buy them, inflation hedge, monetary insurance, portfolio diversification, don't disappear because of counterfeiting. But adaptation requires awareness and discipline. To understand the current situation fully, we must examine why counterfeit silver might be economically attractive to sophisticated criminal operations. Silver currently trades far below its all-time highs, but it remains valuable enough to justify elaborate counterfeiting schemes. The economics are straightforward. A tungsten silver-plated bar might cost $200 to produce. If it successfully passes as a legitimate 100-ounce silver bar, it could sell for $2,500 or more. That's a 1,000% return on investment for the counterfeiter. The risk-reward calculation becomes even more favorable when production happens in jurisdictions with limited enforcement or international cooperation. But there's another dimension worth considering. Some analysts have questioned whether this could be part of a broader strategic effort, rather than purely criminal enterprise. Silver holds strategic importance beyond investment. It's critical for solar panels, electronics, medical applications, and defense systems. Nations stockpiling physical silver while simultaneously undermining confidence in the broader market could theoretically achieve multiple objectives. I want to be clear, I'm not asserting this as fact, but responsible analysis requires considering all plausible scenarios. Whether driven by criminal profit, strategic objectives, or some combination, the effect is the same: increased uncertainty in physical markets. And uncertainty always carries a cost. Let's discuss how markets typically respond to this type of news. The initial reaction is often panic among retail holders and opportunistic positioning by sophisticated players. Retail investors who discover they might hold counterfeit products face a difficult emotional landscape. Fear, anger, and urgency can drive hasty decisions, selling at a loss, avoiding physical metals entirely, or conversely, hoarding out of paranoia. None of these emotional responses serve wealth-building objectives. Meanwhile, institutional players and experienced dealers see something different. They see opportunity in the spread widening between verified and unverified products. They see temporary price dislocations they can exploit. This creates a predictable pattern. Short-term volatility increases. Premium spreads widen. Trading volume in verified products from major mints rises, while generic rounds and bars face skepticism. Then, gradually, the market establishes a new equilibrium with enhanced verification as the standard. Understanding this cycle is crucial because it defines the strategic responses available to different investor groups. If you're an existing holder, your decisions differ from someone considering new positions. Let's address each perspective systematically. If you currently hold physical silver, you face specific questions that demand clear thinking. First, do you know the provenance of your holdings? Products purchased directly from major national mints, American Eagles, Canadian Maples, Austrian Philharmonics, carry significantly lower risk. These coins incorporate security features and come with clear chains of custody. Generic rounds and bars, particularly those purchased from secondary markets or less established dealers, require additional scrutiny. This doesn't mean they're fake. It means you should verify. Second, have you actually verified what you owned? Many investors assume their silver is genuine without ever testing it. This is understandable but not sufficient in the current environment. If you hold significant positions, the cost of professional assaying or advanced testing is justified insurance. Many dealers now offer verification services. Some coin shops have invested in X-ray fluorescence equipment. Is this an additional expense? Yes, but it's far less costly than discovering years from now that a portion of your holdings is worthless. Third, should you sell? This is where discipline becomes critical. If you purchased silver as a long-term inflation hedge or monetary insurance, the existence of counterfeits doesn't invalidate that thesis. It complicates execution. but doesn't destroy the fundamental case. Selling verified genuine silver in a panic at potentially suppressed prices transfers your wealth to more patient buyers. However, if verification reveals problems, or if you cannot obtain reliable verification, then holding becomes speculative rather than strategic. The rule is simple: only hold what you can verify. Everything else is speculation masquerading as investment. Fourth, how do you prevent future exposure? Going forward, establish a verification protocol before any purchase. Buy only from reputable sources with clear return policies. Consider favoring government-issued products over generic bars. Factor verification costs into your total investment analysis. The era of casual precious metals investing is ending. What replaces it is a more rigorous, professional approach. That's not a reason for despair. It's a call to higher standards. If you've been considering entering the physical silver market, this situation creates both risks and opportunities. Let's start with the risks, because honest analysis acknowledges challenges before celebrating opportunities. The immediate risk is purchasing counterfeit products, obviously. But there are secondary risks as well. Premiums are likely to increase as dealers pass verification costs to buyers. Liquidity might decrease as dealers become more cautious about accepting unverified products. Transaction times will lengthen as additional testing becomes standard. These factors increase the total cost of ownership and reduce the asset's utility for quick liquidation. Now, the opportunities. Market uncertainty often creates pricing dislocations that favor informed buyers. When fear dominates retail sentiment, patient capital can acquire quality assets at reasonable prices. More specifically, the current environment favors certain strategies. Strategy 1, focus exclusively on government-issued coins from major mints. American Silver Eagles, Canadian Maples, and similar products trade at premiums, but those premiums buy authenticity assurance and future liquidity. Strategy 2, build relationships with established dealers who have invested in verification equipment and professional practices. These relationships become valuable as the market professionalizes. Strategy 3, view any entry as a long-term position. If you're buying silver because you believe in its fundamental value proposition, short-term market noise is irrelevant. If you're buying for quick profits, you're speculating, not investing. Strategy 4, allocate appropriately. Silver, like all precious metals, should represent a defined percentage of a diversified portfolio. This isn't an all-or-nothing decision. For most investors, somewhere between 5% and 15% of total investable assets in precious metals provides meaningful insurance without excessive concentration risk. The current uncertainty doesn't invalidate silver's role as a portfolio diversifier and inflation hedge. It simply demands more rigorous due diligence. Can you commit to that higher standard? If yes, opportunities exist. If no, other asset classes might better suit your temperament. It's worth briefly considering how the situation might affect gold and other precious metals. Gold faces similar counterfeiting challenges, though the higher per-ounce value makes sophisticated counterfeits more economically attractive to produce and simultaneously more devastating to discover. The tungsten core technique works just as well for gold as for silver. In fact, given gold's higher value, the incentive structure for counterfeiters is even stronger. However, the gold market has historically maintained more rigorous verification standards. Large gold transactions routinely involve assay certificates, known provenance, and professional verification. Silver, by contrast, has operated more casually, particularly at the retail level. The lower per-ounce value meant that verification costs represented a higher percentage of transaction value, creating economic pressure to skip testing. This may have created an environment where counterfeiters saw silver as a more attractive target, easier to introduce fakes into circulation with less scrutiny. If this analysis is correct, we might see spillover effects. Gold buyers may become more cautious. Platinum and palladium holders might question their own verification processes. The entire precious metals ecosystem could be moving toward a new standard where verification isn't optional. It's fundamental. This represents maturation, not crisis. But maturation always involves adjustment costs. The burden of response doesn't fall solely on investors. The precious metals industry itself must evolve rapidly to maintain market integrity. Several changes should be considered standard practice. Mandatory testing. Major dealers should implement multi-method verification for all incoming inventory. Visual inspection alone is insufficient. X-ray fluorescence, ultrasonic testing, or specific gravity analysis should become routine. Chain of custody. Documentation. Every bar and round should have clear documentation tracing its origin. Generic products with unknown history should trade at meaningful discounts, reflecting their higher risk profile. Industry-wide standards. Professional organizations should establish and enforce verification protocols. Dealers meeting these standards should be certified, creating a tiered market structure. Consumer education. The industry has a responsibility to educate buyers about verification methods, risk factors, and best practices. Informed buyers make better decisions and strengthen the entire market ecosystem. Cooperation with authorities. When counterfeit products are discovered, dealers should report them to relevant authorities and share information across the industry. Secrecy protects counterfeiters. Will these changes happen quickly? Probably not. Industry transformation takes time, but the pressure for change is real, and investors should favor dealers who are leading this evolution rather than resisting it. Your purchasing decisions shape market behavior. Use that power wisely. Government response to precious metals counterfeiting has historically been reactive rather than proactive. This may be changing. The U.S. Secret Service, which handles counterfeiting investigations beyond just currency, has indicated increased focus on precious metals fraud. Similar signals have emerged from European and Australian regulatory bodies. International cooperation remains challenging. Counterfeit production often occurs in jurisdictions with limited enforcement or extradition agreements. Even when producers are identified, prosecution across borders is complex. This creates a question for investors. Should we expect regulatory solutions to protect market integrity? The honest answer is partially, at best. Regulations can establish standards, punish violators, and create deterrent effects, but they cannot eliminate counterfeiting entirely. The economic incentives are too strong, and the global supply chains are too complex. What regulations can do is establish a framework that professionalizes the market. They can require dealers to meet verification standards. They can mandate disclosure when counterfeit products are discovered. They can create liability structures that incentivize good practices. But ultimately, investor protection requires investor diligence. You cannot outsource responsibility for your own financial security to regulators. They are a helpful backstop, not a primary defense. This is the reality of markets in an interconnected world. Opportunity and risk coexist. Navigating that duality requires knowledge, discipline, and realistic expectations. Let's be direct about the behavioral errors that destroy wealth during uncertain times. Discovering that counterfeits exist in the market is not the same as discovering your holdings are counterfeit. Don't liquidate verified genuine assets in response to general market fear. You're likely selling at exactly the wrong time to buyers who understand what you're giving away. The opposite error is equally damaging. If you discover you hold questionable products, taking no action hoping the problem will disappear is fantasy. Verify, investigate, and make decisions based on reality, not wishful thinking. Some investors respond to precious metals uncertainty by shifting entirely into other assets, or conversely, by going all in on metals out of defiance. Both are emotional reactions, not strategic positions. Maintain diversification regardless of short-term market dynamics. When markets are uncertain, deals that seem too good to be true almost certainly are. Below market pricing on generic bars from unfamiliar sellers is not opportunity. It's risk you're not being compensated to take. Treating the cost of professional assaying or testing as optional or wasteful is false economy. The expense of verification is insurance. The cost of discovering years later that you hold worthless metal is catastrophic. Sophisticated counterfeits look real. They feel real. They weigh correctly. Visual inspection and amateur testing are insufficient. This isn't about skepticism towards sellers. It's about accepting that modern counterfeits require modern detection methods. Some investors will read this analysis and conclude the entire precious metals market is fraudulent and worthless. That's as irrational as assuming no counterfeits exist. The reality is nuanced. Problems exist. They're manageable with proper diligence, and the fundamental case for holding some precious metals remains intact. Some holders discover they have questionable products and hide this information out of embarrassment or fear. This protects counterfeiters and prevents the industry from responding effectively. Share information with reputable dealers and authorities. You're helping others while helping yourself. Each of these mistakes stems from emotion-overwhelming analysis. That's understandable. Financial threats trigger psychological responses. But understanding these patterns allows you to recognize them in yourself and choose different behavior. Awareness is the first step toward discipline. Let's zoom out from the immediate controversy and examine whether the underlying reasons for holding silver have changed. People allocate capital to silver for several distinct reasons. Silver has unique properties that make it irreplaceable in many applications. Solar panels, electronics, medical devices, water purification. Global industrial consumption continues growing, particularly as renewable energy adoption accelerates. Does counterfeiting change this? No. Industrial users have rigorous verification processes because manufacturing tolerances don't forgive mistakes. They're not the target of counterfeiting operations. Some investors hold silver as protection against currency debasement or systemic financial instability. They view it as money outside the banking system. Does counterfeiting change this thesis? Partially. If verification becomes too difficult or costly, silver's utility as emergency currency weakens. But this is a matter of degree, not kind. Government-issued coins maintain recognizability and verification even in stressed scenarios. Silver, like gold, has historically maintained purchasing power across long time frames even as fiat currencies depreciate. Does counterfeiting change this relationship? Not fundamentally. The inflation hedge argument is about relative value over time, not short-term market dynamics. Counterfeiting creates short-term noise, but doesn't alter long-term correlation patterns. Precious metals demonstrate low correlation with stocks and bonds, providing diversification benefits. Does counterfeiting change correlation patterns? No. Market sentiment towards silver, relative to other assets, isn't fundamentally altered by counterfeiting concerns, though short-term volatility may increase. Some buyers hope silver is undervalued and will appreciate significantly. Does counterfeiting change valuation? Potentially, yes. If verification costs and risk premiums permanently increase, the all-in cost of holding physical silver rises, which could affect price potential. But this depends on whether the market develops efficient verification solutions, which history suggests is likely. The conclusion from this analysis is nuanced but clear. The fundamental reasons for holding silver remain largely intact. The execution of that strategy requires higher standards and greater diligence. The total cost of ownership has increased. But the asset class itself isn't invalidated. This is precisely the kind of situation where discipline creates advantage. Panic sellers transfer wealth to patient buyers. Market dislocations create opportunity for those who maintain rational frameworks. Theory without application is entertainment, not education. Now let's translate this analysis into concrete steps. Step 1. Inventory your holdings. Know exactly what you own, where you purchased it, and what documentation exists. Step 2. Categorize by risk level. Government-issued coins from major mints are lowest risk. Generic bars without clear provenance are highest risk. Everything else falls between. Step 3. Prioritize verification. Start with your largest or highest risk holdings. Professional assaying isn't free, but it's cheaper than holding worthless metal. Step 4. Establish verification relationships. Find a dealer or assayer you trust and build an ongoing relationship. This becomes valuable for future acquisitions and eventual sales. Step 5. Adjust future purchasing behavior. Factor verification costs into all future decisions. Favor products with lower counterfeiting risk even if premiums are higher. The premium is insurance. Step 6. Rebalance if necessary. If verification reveals problems or if your risk tolerance has changed, adjust your allocation. There's no shame in adapting to new information. For potential buyers, Step 1. Define your objective. Are you hedging inflation, seeking diversification, building monetary insurance, or speculating on price appreciation? Your objective determines appropriate strategies. Step 2. Determine appropriate allocation. What percentage of your portfolio should precious metals represent given your overall financial situation, time horizon, and risk tolerance? Step 3. Identify trustworthy sources. Research dealers with strong reputations, professional verification capabilities, and clear return policies. Price shouldn't be the primary decision factor. Step 4. Focus on recognizable products. American Silver Eagles, Canadian Maples, and similar government-issued coins trade at premiums but offer substantially lower counterfeiting risk. Step 5. Start small and learn. Your first purchase should be modest enough that mistakes aren't catastrophic. Use it as a learning experience about verification, storage, and your own emotional response to holding physical assets. Step 6. Plan for the long term. If you're not prepared to hold for at least several years, precious metals may not suit your strategy. Short-term trading of physical silver is inefficient due to premiums, verification costs, and liquidity constraints. Step 1. Maintain perspective. This is a market development requiring attention, not a crisis requiring panic. Measured responses lead to better outcomes than emotional reactions. Step 2. Stay informed. Follow reputable industry sources, understand evolving verification standards, and pay attention to regulatory developments. Step 3. Diversify broadly. Precious metals should be one component of a diversified portfolio, not the entire portfolio. No single asset class is perfect for all scenarios. Step 4. Think generationally. Wealth building happens over years and decades, not days and weeks. Today's market uncertainty is a footnote in a longer story. We must address the emotional and psychological aspects of this situation because they ultimately drive behavior more than rational analysis. Fear is the dominant emotion many investors feel when confronting the possibility that physical assets might not be genuine. This fear is understandable. Physical precious metals represent certainty in an uncertain world, or so we believed. Discovering that certainty itself is questionable feels like betrayal. Some investors will respond by rejecting physical metals entirely, seeking certainty elsewhere. Others will become paranoid, trusting nothing and no one. Neither response serves wealth-building objectives. The mature response is accepting that perfect certainty doesn't exist anywhere in investing. Stocks can become worthless, bonds can default, real estate can lose value, currencies can hyperinflate. Every asset class carries specific risks. The presence of risk doesn't make an asset class invalid. It makes risk management essential. For precious metals, counterfeiting is a real risk. It's manageable through verification, quality sourcing, and appropriate allocation sizing. But it cannot be eliminated entirely. Can you accept that reality and proceed anyway? If yes, you can navigate this environment successfully. If no, choose different assets that match your psychological needs. There's no wrong answer, only honest or dishonest self-assessment. Another psychological challenge is confirmation bias. Those who are heavily invested in silver may downplay counterfeiting concerns to protect their egos. Those who are skeptical of precious metals may exaggerate the problems to confirm their pre-existing beliefs. Both patterns prevent clear thinking. The discipline required is simple to describe, but difficult to execute. Update your beliefs based on evidence, not comfort. If new evidence suggests your holdings are riskier than you believed, adjust. If evidence suggests the problems are manageable, adjust differently. Let reality, not ego, guide decisions. One reason for measured optimism is that technology continues advancing faster than counterfeiting techniques. Modern verification methods are sophisticated and increasingly accessible. X-ray fluorescence, XRF. Devices can analyze metal composition in seconds without damaging the sample. While expensive, they're becoming more common among dealers and larger investors. Ultrasonic testing detects internal structures and can identify tungsten cores or other anomalies. The equipment is relatively affordable and increasingly portable. Specific gravity testing measures density with high precision. While counterfeiters can match density with tungsten-silver combinations, the testing itself is simple and catches many less sophisticated fakes. Digital verification systems are emerging that combine multiple testing methods with blockchain-based provenance tracking. Some manufacturers are embedding NFC chips or unique serial numbers that can be verified against secure databases. These technologies aren't perfect, and determined counterfeiters will continue adapting. But the verification toolkit is expanding, which shifts the economics away from counterfeiting over time. More importantly, as verification becomes standardized, it becomes priced into normal market operations. The temporary disruption we're experiencing now eventually settles into new norms. History demonstrates this pattern repeatedly. Credit cards faced counterfeiting problems and evolved to chips. Currency introduced security features. Markets adapted. The precious metals market will adapt as well. The question isn't whether adaptation happens. It's how quickly and at what cost. Investors who position themselves ahead of this curve benefit. Those who resist or deny the need for change suffer unnecessary losses. Which group will you join? We should briefly consider the broader geopolitical context, though speculation should be labeled as such. China is the world's largest silver producer, accounting for roughly 13% of global mine production. It's also a major consumer of silver for industrial applications and, increasingly, for solar panel manufacturing. The Chinese government has demonstrated strategic thinking about commodities and resource security. Accumulating real silver while potentially flooding markets with counterfeits could theoretically serve multiple objectives: undermining Western precious metals markets, acquiring physical metal at suppressed prices, and creating strategic advantage in critical minerals. I want to be absolutely clear. I am not asserting this is happening. I'm noting that it's plausible enough to consider. If true, the implications extend beyond individual investment decisions. It suggests precious metals. Markets may increasingly be influenced by state-level actors, pursuing strategic objectives rather than purely economic ones. This would represent a significant shift in market dynamics and would argue for even greater diligence in verification and sourcing. But whether the current situation reflects criminal enterprise, state strategy, or some combination, your response as an individual investor remains the same. Verify what you own, be cautious about what you buy, and maintain appropriate portfolio allocation. Geopolitical speculation is intellectually interesting, but strategically not actionable for most investors. Focus on what you can control: your own verification standards, source selection, and risk management. Market dislocations create opportunity for those with clear frameworks and patient capital. The current situation is creating several specific opportunities. First, a widening spread between government-issued coins and generic products. This spread will eventually narrow as verification becomes standardized, but in the interim, quality products may be available at reasonable prices because overall market sentiment is suppressed. Second, dealers who invest in verification infrastructure will gain market share and customer loyalty. Identifying and building relationships with these dealers now creates long-term value. Third, investors who maintain discipline while others panic can accumulate quality positions. This is the classic "be greedy when others are fearful" opportunity. though greed should be tempered by proper verification protocols. Fourth, the market is being forced toward higher professional standards. Once established, these standards increase overall market integrity, which benefits long-term holders. But opportunities only materialize for those who can maintain emotional equilibrium during uncertainty. Can you be calm when others panic? Can you think clearly when others are confused? Can you act deliberately when others are paralyzed? These capacities aren't innate. They're developed through preparation, through understanding historical patterns, and through maintaining perspective about what truly matters. A properly diversified investor with rational allocation to precious metals should not be destroyed by counterfeiting concerns. Inconvenienced? Perhaps. Required to adjust? Certainly, but not destroyed. If the possibility of precious metals counterfeiting threatens your financial security, you're overconcentrated. That's the real problem requiring attention, not the counterfeit market itself. As we move toward our conclusion, let's define what successful navigation of this situation looks like. Success is not making a fortune from market dislocations. Success is not predicting exact price movements. Success is not even avoiding all exposure to problematic products. Success is maintaining rational decision-making under uncertainty. It's updating your beliefs based on evidence. It's taking appropriate action without overreacting. It's protecting wealth while remaining open to opportunity. More specifically, a successful holder has verified their positions, adjusted their allocation if necessary, established sources for future purchases with appropriate verification protocols, and maintained long-term perspective rather than making emotional decisions. A successful potential buyer has evaluated whether physical silver suits their objectives, determined appropriate allocation sizing, identified trustworthy sources, started with modest positions to gain experience, and committed to long-term holding rather than speculation. A successful market participant has stayed informed without becoming obsessed, maintained diversification across asset classes, avoided the behavioral mistakes we discussed earlier, and recognized that uncertainty is normal, not exceptional, in markets. Notice that none of these success definitions involve becoming wealthy quickly or avoiding all risk. They're about process, discipline, and rational behavior. This is what separates investors from gamblers. Gamblers seek certainty and guaranteed outcomes. Investors manage uncertainty and probabilities. The current situation with silver counterfeiting doesn't offer certainty. It offers an opportunity to demonstrate whether you're truly an investor or just someone who's been lucky so far. Which one are you? We've covered substantial ground in this analysis. Let's synthesize the essential points. The precious metals market, specifically silver, is facing legitimate concerns about counterfeit products entering circulation. The alleged scale, 60 tons, is meaningful but not catastrophic. The sophistication of the counterfeits is the real concern, as it challenges existing verification systems. This situation requires response, but not panic. For existing holders, verification of current positions and upgraded protocols for future purchases are essential. For potential buyers, focusing on government-issued products from reputable sources and committing to long-term holding periods creates appropriate risk management. The fundamental case for including precious metals in a diversified portfolio remains largely intact. Industrial demand continues growing. Inflation hedging properties persist. Portfolio diversification benefits endure. But the execution of precious metals investing is becoming more rigorous, professional, and verification-focused. This is maturation, not destruction. What matters now is your response. Will you allow fear to drive hasty decisions that transfer your wealth to more patient capital? Or will you respond with the discipline that builds lasting wealth? Will you ignore warning signs and hope problems disappear? Or will you take appropriate action based on reality? Will you treat the situation as a crisis that validates your pre-existing biases? Or will you see it as new information requiring thoughtful adjustment? These questions reveal more about your investment success over time than any specific asset allocation decision. Because markets will always present uncertainty. Asset classes will always face specific challenges. New information will always require adaptation. The investors who build generational wealth are those who maintain rational frameworks during uncertainty. They're the ones who verify rather than assume. They're the ones who adjust based on evidence rather than emotion. They're the ones who maintain long-term perspective when others are trapped in short-term thinking. You have an opportunity now to demonstrate these qualities. The silver market's counterfeiting concerns are a test, not of the asset class, but of your decision-making process under stress. Passing this test isn't about achieving perfect outcomes. It's about maintaining rational process. Verify what you own. Be cautious about what you buy. Maintain appropriate diversification. Stay informed without becoming obsessed. Act deliberately rather than emotionally. Do these things, and you'll navigate the situation successfully regardless of how the market ultimately develops. This is the discipline that separates wealth preservation from wealth destruction. This is the temperament that allows compounding to work its magic over decades. This is what it means to be a serious investor, rather than someone who occasionally speculates with money they claim to be investing. The choice, as always, is yours. I encourage you to think carefully, investigate thoroughly, and act deliberately. The markets reward patience, discipline, and rational thinking. They punish panic, overconfidence, and emotional decision-making. Which outcome will you choose? Thank you for your time and attention. If you found this analysis valuable, I invite you to subscribe for future insights. We focus on clarity, discipline, and long-term thinking in a market environment that often prioritizes neither. Until next time, stay rational, stay diversified, and stay focused on what truly matters, building lasting wealth through disciplined decision-making.